Welcome everyone. Welcome back. Welcome back. Welcome to the new people. I think Joel, we should have.
We
Yeah, they're still trickling in here.
still streaming in. Yeah, we'll wait a little bit to go over expectations and agenda.
All right. Stacy, what's up? Mr. Braun, how you doing, buddy?
Is
Jessica,
that
second time in a row. She's 2 for 2. She just started out and 2 for 2.
all right? Is that Cherry I see there? Yep, got Cherry. She's a newbie.
Right. Mr. Braun, if you don't mind, I might put you on the spot a time or two today, if that's okay.
No problem. Anytime.
All right. Just so everybody knows, David is an engineer by trade, business owner now, and so I want to use his analytical mind. And he doesn't mind being wrong because you're very much going to probably be wrong on this mathematical question I ask you in the future. But I
Yeah.
know.
Yeah, I'm used to being wrong, so it's no problem.
All right, man.
David, I'm betting on you. I think you're stumping West this time.
We'll see. We'll see. All right. I think that's everybody coming in. Hey guys, just so everybody knows, I really want to thank you guys. This idea seemed so obvious in the past to do. Of hey, like, why don't we make investing a community sport? Where it doesn't have to be taboo to talk about money. How about we just talk about it? And then, as we go through our meetings every single day, why don't we just bring those topics up that are brought? Because now we have the technology to be able to talk about these things. So it's cool to see this idea come to fruition. And now, we have, right, as you guys can see, and there's a lot of people who are not on video right now. Many investors show up every week or every month. It's really cool. And then we have a whole bunch of investors who watch it after it's recorded. So we want to thank you guys very much for making this community. It's a really cool thing for us to see. But anyway, let's get started. Got a few things on the docket. Just want to have a level set, and real quick run through a quick framework that we think about pretty frequently. And I apologize if some of you have seen this, but it's really important. So the age-old debate on stocks versus bonds or debt versus equity. So Mr. Braun, if you don't mind being our our guinea pig today, what do you think the average investor says that stocks are risky and bonds are what?
Safer.
Yep. So I want to address that, but we always want to teach how to think, as Elon Musk would say, from first principles. So let's think from the ground up. So let's take an easy example. Let me see if you guys can see my screen here. 1 second. Colin, I'm going to ask you if you don't mind. Let's go to my OBS. Okay. All right, Colin, can you see my screen, bud?
All good. Yep.
All right. So let's say we have $1 million property, let's just say, and you have two options. You could take that $1 million and you could do the debt side. So you could lend Colin the money, David, Ron, you could lend him the money and he could pay you a coupon of, let's say, $70,000, because David, is it fair to say that today's interest rates for mortgages are around, let's say, 7%? Is that a fair assumption?
That's fair.
All right. And then what would you say is the typical mortgage duration?
For like a home would be
Yep.
typically maybe 30 years. Some do
Yep. So
15.
let's say
some do
30
more.
years. Yep. So I'd pay you 30, I'm sorry, over 30 years, $70,000 per year over a 30-year duration. And the final payment I would give to you would also be $70,000, assuming a fixed rate loan. Is that all of that a fair assumption, bud?
Sure.
All right. So if we go forward with that assumption and we look at my screen, I would also then give you your $1 million back over time, probably amortized over that 30-year duration. Now, that's the debt side. If we then look at the equity side, right? Let's assume instead you said, David, you said, hey, Wes, I don't want to lend you the money. I'd rather just buy that home myself, and I'm going to rent it out. And then I'm going to increase the rents every year. So let's just say I rent it out for a similar number that the mortgage service would be. So $70,000 a year. Now, this is where it starts to get interesting. Again, this is on the equity side. David, what if you were a good landlord and a business, had a business mindset, what would you do with those rents every year?
Well, you would take some of that and invest it elsewhere.
Yeah, and let's just say, but the actual rent, is it fair to say that landlords should increase their rents on a
Oh,
continuous basis?
yeah, you would
Okay.
increase them. Of course, you have to
Yeah.
offset that against increases in property taxes and insurance and those kind of things as well,
Yep.
right?
100%. So now let's say this. What do you think? So you live in Orange County, using apples to apples comparison, what do you think rents will be in 30 years from today? Now, before you answer that, think about what rents in Orange County are today versus what they were 30 years ago. What do you think a good multiple would be to increase those rents?
Oh, from say 30 years ago, I would say because we actually rented something similar, probably I would guess around probably like a 6x.
Yeah, I agree with you. So let's even make it super conservative and let's just say a 3x. So let's just say we go from 70K to 210K per year. Is that
Okay.
fair?
Yep.
Probably super fair, right? Now, you also have the $1 million property, right? So what do you think would be a fair appreciation multiple over that same 30-year period of the property?
It probably would be way more than that, more than 6x or
Yeah.
3x, more than
y-
3x.
Yeah. So again, let's cut it in half just to be super conservative. And let's just say it's a 3 multiple, so you get $3 million. Now, here's
Okay.
another kicker. What do you get to keep at the end of that 30-year period if you're on the equity side?
All of it.
Yep. And you get to keep the house.
Yep.
Right? Versus over here on the debt side, guess what? You do not get to keep the house. It was just a contract for 30 years. You get the payments.
Mhm.
Now, to go even further, and here's the real X factor. We have a pesky little thing called inflation, right? So over here on the debt side, you have to really be concerned about how inflation messes with the purchasing power of those dollars, of the cash flow. So, David, would you also say it's fair? We've now taught many people, almost 6,000 students in our classes. I don't say that to brag. I'm saying because we typically get a lot of patterns of numbers. General CPI inflation. We've never had one client tell us that they actually experience only the inflation of general CPI, which, David, sorry to put you on the spot, but what is CPI generally? Between what number and what number for consumer price index inflation?
What generally that's been lately, I don't know, 2 to 5, 6%, something like that.
Yeah, so it's generally between 2 and 4%.
2 and 4.
Now, the problem with a lot of retirement models is they use those numbers. Let's say they pick about a 3% number. But David, if I had to ask you what, just to cherry pick some data here, what do you think your personal inflation is? And if it's hard to answer, like think about what your groceries have increased for you personally out here in Orange County last year, between this year and last year. What do you think? Or you pick whatever inflation number you want.
Well, I'll make a comment on that, but between last year and this year is probably another, I don't know, 7 or 8%, something like that. Before
Yeah.
that, it was probably more.
Yeah. So and if anybody has any comments on this, please shoot them in the comments. Um, if we pick, if we pick an, I don't know, an 8% number, David, after 8% inflation, right? What do you think that's over a 30-year period, because we're using a 30-year mortgage, right? What do you think that $70,000 would actually be worth over 30 years? So in
Huh.
other words, what would the purchasing power of that 70K be worth?
Let me get my calculator out, but the
Don't
purchase,
cheat, dude.
I don't know, maybe 300K or something like that.
No. So the purchasing power, so inflation is
Oh, what did we actually be
deteriorating the value.
worth?
Yep.
Oh, so probably, I don't know, maybe 20K.
Yeah. This is crazy. $5,737.
Yeah.
So when people are signing up for bonds and they say, well, hey, bonds are, what they're really saying is bonds are less volatile. Now, here, let me show you this. David, I'm going to ask you a trick question. Which would you rather have? The debt side or the equity side?
Well, I would think I would want the equity side.
Right. So what you're really saying is in the long term, I'd want the equity side. The reason it's a trick question is because, hey, if it's a short-term need I have, 6-month need, a year need, I'll take the bond coupon all day long, right? Because the cash flows are going to be more stable, right? And by the way, if I take the equity side, hey, what if I buy that property? I need the money in 6 months, and the renter moves out or something like that, right? But
Yeah, of
but
course.
over the long term, in my view, the math becomes quite obvious. And I don't, it's not our job to give anybody the answer, so to speak, but it is our job to highlight the math. I know very few individuals who would sign up for, yeah, I want that $70,000 payment that you're going to be. I want it to be worth about 5,700 bucks when it's all said and done. That to me seems crazy. Colin, let me throw you over the mic, and Joel thereafter. What are your comments on this? I know this is maybe juvenile and elementary for some people, but this is an age-old debate of, hey, are stocks riskier than bonds or vice versa, et cetera? And my answer is it depends on the time horizon.
Yeah.
Yeah, time frame matters a lot, right? The context is important. And that's why when you hear these general rule of thumbs, you have to not take it in a general capacity. You have to overlay it on your personal situation, right? So when somebody says something in a very general manner, they can be talking to somebody with $500 in their investment account or $500 million in their investment account or somewhere in between. How does the same general advice apply to everybody in every scenario, right? So when we work with clients, we have to tailor them or customize their investment portfolios based on the goals over specific time horizons. One thing I like to talk about when we start to discuss inflation, and Wes mentioned it a few times, is not to think about your dollars in units of currency, which is a really easy trick to stumble over, right? So if I just had $100 bill, I would have 100 units of US currency. But we need to think about it in terms of purchasing power. So Wes referenced purchasing power. What did $100 buy you in gasoline when you first started driving at 16 versus what it would buy you today? Right? You'd probably fill up 5 cars, 6, 7 cars 30 years ago with $100. Today, me and my wife can maybe fill up both of our tanks for $100, right? So the same units of currency buys us far less goods and services in the marketplace because of that pesky inflation. So when you do the calculations, you have to do it on both sides of the coin, right? So yes, it'll generate a 7% interest rate, whatever it might be. However, after I reduce inflation or taxes or maybe both, what am I left over in terms of purchasing power? And yes, it is massively skewed in the ownership vehicle's favor the longer this goes out. I don't want to say something that's untrue, but I'm pretty certain that over a 20-year rolling period rate of return in the U.S. stock market, there has never been a down market over a 20-year period, right? And so in U.S. equities, there's never been a 20-year period where stocks have been down. The longer it goes out, the safer the equity or the ownership vehicle becomes. But again, it is very much contextualized to what are the goal of these dollars and how much time do we have. If you need those dollars in 6 months, we would never be having that discussion of we should become an owner with these dollar bills.
Well, and then to add to that narrative, Colin, not only that 20-year number, it's also that doesn't factor in the dividends that one would receive, assuming they're investing in productive assets, and that changes the entire scope of that argument. In case somebody says, "Oh, well, 20-year period's a long time," it's like, no, we're not even talking about the dividends and the reinvestment of those dividends. Also, by the way, that model that I was showing earlier, the reason I was showing with the house is so that it's just a little easier to understand. It's the same exact math on a public company. Do you want to lend your money to a public company, right, via a bond, or do you want to own the shares of that public company via the equity? Also, same exact thing for a private business, right? Like Stacy, as an example, owns her own private business. It's the same math, right? Do you want to lend somebody else to build the private business, or do you want to own the private business? Same exact math. Joel, let me throw you the mic, bud.
Can you put the picture back up? Do we still have that?
Yep. Give me one
Because I think
second.
you guys covered the actual talking points extremely well. But where I think the benefit of this is and what our job boils down to is that we can draw what don't you see on here? You don't see rows of columns of numbers. You don't see spreadsheets. You don't see rates of return. What you see is the concept drawn out straightforward and simple in a way that everybody can actually understand and benefit from learning this information. I think that's our job as advisors. It's our job with our clients, and it's our job when we teach our classes. And I think seeing it in this form resonates with everyone. It doesn't put you to sleep, to be quite honest with you, right? Yeah, the spreadsheets and the numbers are really cool for some people, but generally, most people want the concept. They want it explained simply and straightforward to them. Once they get it, they're good with it, and they can move on, and they can put their head on the pillow at night because they understand the general principle here. They don't need to know all the math behind it for the most part. Now, some of you do. I understand that. You love your spreadsheets and you love, studying all the numbers and breaking it all down. Wes, David, you're probably like that. Wes, you're definitely like that. Colin, I know, loves it. But for the most part, when we're talking to clients, they just want to know that the concept works, they understand it, and they can lay their head on the pillow at night knowing that they're invested in a certain way and that it's going to be successful for them.
Right. And to add to this, I've been trying like literally for years to think of a proper analogy, because I think when people talk about risk, let's actually break down that terminology. And Warren Buffett has talked about this many times. He says basically people misunderstand, they're misusing the word risk. What they're actually referring to 9 times out of 10 is they're referring to volatility. So I've been trying to think of a way of like sort of symbolically referencing this. So if you think about it like this, volatility, and David again as our guinea pig here, let me know if this resonates. Volatility is waviness, right? You got waviness. Now, when I was in finance school, they taught us that, hey, $1 million risk is $1 million risk. And I would actually argue that it's a little more nuanced than that. It depends on who the investor is. As an example, if I invest $1 million of my money, I guarantee you that feels different than if Jeff Bezos invests $1 million of his money, right? Now, as an elementary example, imagine we're on the middle of the ocean here. If you're on a surfboard in the middle of the ocean, or a canoe, let's say, those 30-foot swells are going to impact you differently than, David, let me put you on the spot. What do you think would be the best sea vessel to be in the middle of the ocean during a storm? What do you think the best sea vessel? Probably not a canoe. What do you think?
Yeah, the bigger the better.
Right. Yeah. So would you say like a cruise ship, something like that? Because you get
Yeah.
the larger the surface area, you get more water displacement, the more buoyant, et cetera, et cetera.
Right.
Now, that is one option. I would actually argue, and I think it's a great answer, I would actually argue a submarine,
Mm.
right? Being below the waves. And think about this in terms of your portfolio. You want multiple sort of like striations between you and the peaks and troughs of the waves. This is how we set up portfolios, right? You think about it like this. We've talked about this before. You have a short-term portfolio, a medium-term portfolio, and then a long-term portfolio, right? So that for you at the investor level, the family level, that you have many cushions between you and volatility. Now, you're never going to get rid of the human experience. Why? Because you're going to have neighbors, you're going to have friends, you're going to have the media that tell you the world's going to hell in a handbasket. That's just a human condition. But if pragmatically you can shield you and your family's income and expenses so you can keep on living your life even during the storm, that's what we create. So think of the submarine analogy as opposed to being on a canoe in the middle of the ocean. David, is that a fair analogy, bud?
Yeah, that makes a lot of sense. A lot of
All right,
sense.
cool. Okay, now, Colin or Joel, any comments on that? How do you, on a scale of 0 to 10, how do you like my submarine drawing and analogy? I think it's pretty spot on.
It's better than that chicken you usually draw.
No, that's fantastic, right? And again, this is, just back to customizing the portfolio at the family level based on your goals and your time horizons. It's why those generic one-liners are dangerous if you don't apply the correct context to them.
Yep. So again, not to beat a dead horse, but I really want you guys to think about the power of inflation and how destructive it really can be on your portfolio. And as a funny little anecdote here, I will share my screen. This is what we teach in the classes. It's just a good way of thinking about inflation. So inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair. So how does that impact you? You think it in, like, let's say an equity standpoint. If you look at this graph right here, cumulative after-tax dollar real returns, meaning adjusted for inflation, gain on $1 invested in stocks versus bonds. That dollar invested in 1924 in the S&P 500 would have been worth $488.25. In the bond counterpart, 10-year treasuries, after inflation, it would have only been worth 7 cents. So this is just us doing our part of saying, hey, be real careful when you sort of reflexively say bonds are more conservative and stocks are more aggressive. That really, really, really requires context. All right. Colin, anything to add to that, bud?
Just other than this is the actual math. My dad, Wes, myself, the rest of our team, we don't really care what the general narrative is there, right? If it were to lead us into bonds as the best long-term investment, then that's what we'd do. We have no affinity or affiliation with any investment vehicle on the planet, right? But that is the actual inflation adjusted real return of $1 over a 100-year period, right? You lose 93% of your purchasing power in interest-bearing vehicles. It's just the data, right? So that's why we feel so passionate or feel so strongly about the education, because that is not the general narrative. The general narrative is that, hey, in retirement over a 30-year period, that it's safe to invest in those type of vehicles.
Right. Absolutely. So now here's the other segment that we want to talk about. What you have to understand is start looking at your investments for what they actually are. These are businesses, right? Or if you're investing in real estate, it's real estate. If you have a private business, it's a business. Part of the problem in the air quote stock market is people are not actually, number one, a lot of people don't do it correctly. They treat it more as gambling, which that's not what we're doing. But you are investing in businesses. So let's understand that for the type of investing that we're talking about, investing is business. So we want to highlight, right? Let's say one of the businesses that you could own. Now, we're going to go through some high-level analysis here so you can really start to grasp what's going on under the surface of when you get your statements. We're gonna analyze Costco a little bit because we have licenses and so on. Just a quick disclaimer: we are not recommending buying Costco. This is not an endorsement for Costco. It's just to illustrate a real life point because we think that's helpful for investors. So let's go down and let's look at this. If we look at Costco, it's unbelievable to think about how much money some of these companies make. So this is Costco's revenue chart over a 20-year period. Right? If we look and we say, okay, Costco in 2024 made over in revenue, this chart is in billions, $250 billion in revenue. Right? So we say, okay, well, is there substance to that? Why does that exist? Okay, let's go a little deeper. Let's look at Costco's locations over the last 20 years, right? Okay, great. Look at how their locations are increasing over time. Okay, well, how does that impact us as investors? So great, they're making a bunch of revenue, they're expanding locations, which means they're selling more goods and services. Okay, how are they helping us as investors? Well, if we look here, look at their dividends chart over that same time period. You'll start to notice a trend in this. Again, not recommending buying Costco, just to illustrate some points here. What that means to you, right? If we look at the revenue, how much money Costco makes per day. Costco makes approximately $697 million per day in revenue. Okay, what does that mean? Per hour. Almost $30 million an hour. And by the way, I ran this over a 24-hour period, not just hours of operation. $29 million per hour. Now, somebody might say, okay, well, that's great. you know, but they have so many locations. I just saw that chart above. So, maybe they kind of run out of steam. Okay, cool. Let's look at a chart of Costco's locations in the United States. I mean, look how many locations they have, but look how much surface area is completely blank, right? Costco is a pure example of what capitalism, what a business can scale to. And oftentimes we just think in our heads, oh, well, yeah, but they don't have a lot of runway. It's like, look at how much blank space is on this map. And by the way, obviously, this is only a map of the United States. Colin, what's your take, bud?
Yeah, it's fascinating, right? We should, and I can look into doing this, but when we start looking at this globally, right? Wes just said it. This is only the United States. Wes, how many Costco's in Southern California do you have within like a, let's call it like a 20-30 minute drive just in your area?
Oh, I could tell you within a 15-minute drive, I've got five. In a
Five of
30-minute
them?
drive, there's probably 10. Yeah, David, would you say it's a fair estimate? Probably five around Irvine.
An hour, other locations.
Oh, David, you're on mute, bud.
Southern Orange County has got like half a dozen for sure.
Half a
Just-
Yeah,
dozen?
it's crazy.
Yeah. Dave, we might have asked you this before, but how many do you think are in all of China?
I
So
would-
if there's six around you in just Orange County right there, just take a guess. I got this totally wrong when I first guessed.
I would say it's definitely disproportionate to like what it is here. It's probably a lot less,
Yeah,
which means it's got a lot of room to grow, but I don't
right.
know.
Yeah, in all of China right now there's seven.
Yeah.
Yeah, so six or half a dozen or so around you just in Southern California, and where there's a continent of 1 billion people, they have seven total locations. Right, so to Wes's point, the runway to expand the company is virtually infinite in the next decade, 2 decades, however many decades that you want to apply there. Um, and if you think like, oh, well, maybe it wouldn't be well received in China, which, hey, different marketplaces call for different conditions.
The growth is
They
gonna
had to
be there.
shut down the Costco, the first one that opened in China, within the first 2 weeks because too many people came. Right? This is the best problem that a business could possibly have. They have too many customers coming in the front door. Right? So the chart that Wes just showed of not only the Costco's revenue over time, but locations, they have actually gotten disproportionately more efficient within the business. When you see revenue 5x, locations a little more than doubled, right? So double location, but revenue, five or so x over that time. They have a playbook, and they're able to repeat that playbook in many different areas across the world, right? And because they're better at business, they're better at adding the next Costco than they were the previous Costco. The net revenue and therefore profit goes up over time because of it. So this is pretty fascinating to see it highlighted though, just in the United States here.
Yeah, and Joel, I want to get your take on not Costco the stock, but Costco the business. What's your perspective?
Well, I did have a question, so I don't want to get too deep into things that I can't really talk about, but
Yeah.
I would like you guys to comment on one thing. Costco, the business is phenomenal. You guys are making me hungry, so I'm going to go get some free samples after this. But
Right, buddy.
can you talk to the idea of what most people, when they look to make an investment, they think, oh, Costco's always crowded. The parking lot's always full. Must be a great company to own, correct? Versus, and you guys are just dipping your toe in the water here. What you're actually doing, the beginning of an actual analysis of an investment and how you do that to determine whether a company is worthy of investing in or not.
So, sorry, Joel, can you summarize that question? I just want to make sure I get all of it, bud.
Yep. So most people, I think the general public's idea would be to drive by Costco and look at it and say, parking lot's always full. It's got to be a great company to own. And that's the extent of the analysis, basically.
Yeah.
You guys, this isn't even close to what you guys do, by the way. You're just dipping your toe into the thought process and the analysis that goes into our investment process. Can you talk about the difference between my first scenario of the drive-by, seeing the parking lot always full, let's invest in Costco, versus what you guys do on a daily basis to determine whether an actual company is worthy of making an investment into.
Yeah, great question. So I think this is very common in the restaurant industry. Like the amount of times where I hear people say, "Oh my gosh, like it's the best restaurant on the planet." There's people lined up out the door, and then the restaurant goes belly up, 6 months later. Um, the answer is you got to pop the hood open, right? Let's actually see, right, the P&L. Let's actually look under what's going on underneath the surface. Because just because you have a great product or just because you have what appears to be a great service, does not mean that the business is operating efficiently. And this, by the way, Joel, to your point, again, not recommend this as an investment, not that it's even a public company, but if you ever looked at Chick-fil-A, I'm fascinated with Chick-fil-A because, in my opinion, these guys are just right. Like they are just sticklers for operations. They apparently have rented out stadiums for this is what I've heard. Like they'll rent out a stadium and they will manufacture their parking lot and try to figure out the most efficient geometry of operations on how to get more throughput through their drive-through. Right? It's crazy, right? Like that level, that's what happens when you stick with one plan, like one goal, and we're just going to keep on optimizing that. How do we feed more people more chicken? Not expand our menu to a million things, not get into all these other widgets and all these different types of things. We're going to do this one thing and we're going to do it the best on the planet. That's the goal. So imagine if you were trying to compete against Costco, how almost impossible that would be. If you said, I want to start a warehouse business and deliver a bunch of goods and services at a discount and charge a membership fee, it would almost be impossible. You'd be a dead man walking. You would be done before you started because you're competing with all the decades worth of innovation and the efficiencies meant on one goal. Colin, what's your take?
Yeah, I love it. And I think to my dad's question, the analysis that we do on an investment is on the cash flows, right? So we are not looking at, oh, hey, what can we buy this company for at any given moment on any given day, right? Just what the price of it is today. And if I bring that down to a local level, looking right out my office window here, there's a pizza shop across the street. I highly, highly, highly doubt that the owner of that pizza shop makes decisions based on a day-to-day basis or even a month-to-month basis based on what the value of the pizza shop is at any given moment in time, right? I'm going to guess that he or she looks at the cash flows, looks at the sales, looks at the revenue generation, looks at overhead, looks at expenses, and says, hey, I can open up another location, right? And I can scale up the cash flows of this thing because I've got a playbook here that I can repeat, I can put forward, I can do it across town because it's an underserved market, whatever it is, right? Not I'll open up a second location because I can sell this pizza shop for $100,000 today, and last year I could sell it for $80,000. It's not the way that anyone buys real estate for sure, right? If someone's going to buy a rental property, hardly do they think, hey, I could buy it today at this price. 30 years from now, when the mortgage is paid off, I'll be able to sell it for this price. No, they think, hey, I could put a renter in here and the rent's going to be X per amount of dollars per month. And let's just say that's $1,000 per month, $12,000 a year. I'm comfortable paying $100,000 for this property because I know that I'll get a return of cash, right, of $1,000 a month, roughly speaking, right? So it's just a different way that we look at it. And when we zoom in on a company like Costco, and again, just to make the disclaimer, we're not recommending Costco. They are providing a valuable service to the marketplace. When that stops, right, or if that were to ever stop, you will see the cash flows follow, right, in the wrong direction, right, because the marketplace will no longer perceive it as valuable, and therefore, eventually, the stock price will catch up, right? But it'll first likely be recognized in the revenue and the cash production of the company. But this is precisely why we stay away from speculative investments of all asset classes. We happen to talk about business the most because that's where most of our clients have their money, right? But it would be true in farmland or storage units or real estate or anywhere else for that matter.
Right. Completely agree. So
can I add to your
yeah, please.
Chick-fil-A story, Wes? So about 3 or 4 years ago, my daughter Brooke, her car broke down. It was about 45 minutes away. She got a ride home, but I had to go over and call the tow truck and get the car towed to the repair shop. So I get there, and when I made the call to the tow truck, they told me it was an hour and a half wait, which I did not anticipate. But there was a Texas Roadhouse right next to where her car was in the parking lot, one parking lot over. So I go into the Texas Roadhouse and order an appetizer and a cup of coffee at the bar to kill time. And I start talking to the guy next to me. The guy next to me happens to be a regional manager out of Atlanta for Chick-fil-A. He was in the area not to, they had put a pause on building new locations. What they were doing is taking existing locations and increasing the drive-through lanes from 1 to 3 on each location. And the thought process was we can go in and we can drive down expenses, but increase profits on every single store. We don't have to build new stores. We're actually reducing expenses and we're increasing profits at every store into the future. And if you look at every Chick-fil-A out there, almost everyone I see now has 3 drive-through lanes, not just one. That's the result of that plan that went into, that took fruition 4 years ago when I sat next to that guy and talked to him for an hour and a half. It was a fascinating conversation, and he had nothing good but good things to say about Chick-fil-A because he loved working for the company. So he agreed with you that it was a fascinating story, a fascinating company. But it's also what I think, preach to the people we work with, the families that we work with. We should be running our family finances like a business, right? It shouldn't be haphazard. It shouldn't be siphoned out into, oh, I have a financial advisor, I have an insurance advisor, I have a CPA, I have an attorney, and none of them know each other, and especially none of them talk to each other. That's the largest no-no I see in our industry by far. One of the greatest things I think we do, for hopefully for you all on the call, but in general for the people that we work with, is we become the head of that board of directors and get all of those people talking to each other. It's the only way you would run your business if you owned one. It's also the only way you should run your family finances, because it will do the exact same thing that Chick-fil-A was doing: drive down cost and increase profit over time. And I don't know a business owner that we've ever talked to that, if we didn't go in the door and say, hey, if we could drive down costs and increase profits in the next 5 years, would that be worth it to you? There's not one that, I mean, what one would say no to that question. You can't say no to that question. It's an absolute no-brainer.
Yep, completely agree. So sticking with the theme today of understanding investing is to understand business. We've been talking a lot about AI and just about increase in productivity through robotics. And so I'm a huge nerd on this stuff in particular, because it's going to give, like, when the media talks about GDP, short-term GDP is there's financial tricks you can do with it. But long-term GDP is about productivity. How much more can we produce per unit, per human, right? Per business, per et cetera. It's about how do we get more efficient and produce more value to other people. Now, the cool thing about the human condition is that once problems are solved, it creates more problems. As an example, I've recently taken up pickleball. I have gotten beaten in pickleball, which is a problem, right? The first problem was I never played pickleball. I want to play pickleball, so I get some paddles. Then I lose, and to lose to me feels like I cut off a finger. It doesn't matter what I lose in. I despise losing. It drives me crazy. So now I have got a new problem. So now I have to get better pickleball paddles. Then I have to get pickleball shoes, right? Each problem that I solve then opens up like a Russian nesting doll, and it creates more problems that then have to be solved. This is why we can keep on creating new industries, et cetera. The field of robotics, I'm going to show you guys a speech. Again, not recommending this company, but it's really fascinating. If anybody has ever heard of Gecko Robotics, it is fascinating. I want to show you guys a couple minutes of this here just to show you what curve we are on, the amount of, let's say, infrastructure that just the United States has alone that needs to be replaced. I mean, David, you would probably agree as an engineer, right? The amount of bridges that need to be replaced, the amount of oil and gas refineries that have decaying materials, et cetera, et cetera. So, David, is that a fair statement from an engineer standpoint?
Oh yeah. And it's a
So,
constant.
oh yeah. So I want to show you guys this. We're gonna do movie time real quick, just a few minutes. Bear with me, and then I want to pass the mic around. So let me show you guys this. And Colin, if you don't mind, let me know if you can
Popcorn.
hear this, bud. Yeah,
Gecko Robotics builds wall.
Colin, can
Turn
you
it
hear
up a little bit, but yeah, we can hear it. Yeah.
that? Okay, let me see. Yeah, you guys might have to turn it up a tiny bit. I don't know if it's going through my computer's audio. So, Colin, let me try again.
Gecko Robotics builds wall climbing robots and enterprise software to maintain and protect essential infrastructure.
He is the CEO and co-founder at Gecko Robotics. Jake, thanks for joining me today.
Every hour you save, you're saving potentially millions of dollars. Hardware is hard. Be very careful. There's a lot of really important problems to solve. There's so much sex appeal to building new things, but you gotta get the business model right. The business model has to make a CEO or a CFO give a
There's a huge fire going on right now at Philadelphia Energy Solutions. Oh my gosh. Well, again, this guys, look at this video right now.
Today, the Navy remains a formidable fighting force, but even officers within the service have questioned its readiness. At a missile silo we visited, time and frigid weather had clearly taken their toll.
Developing right now, gushing for hours with no end in sight. Thousands of barrels of crude oil spilling from a tank.
The report does an estimate of what the need is to bring the overall grade up to a B, which is what the society sort of determines to be adequate. And it's like 4.59 trillion.
So first what we do is we gather information about the asset by customers sending us their metadata. Then we build out a digital representation of that asset inside of Cantilever. And then we send in our robots. First, we use a drone. You can see over here. Now, the drone is armed with cameras that are doing a photogrammetric scan of the asset. It enriches the asset model itself, being able to identify different kinds of defects using point clouds. So corrosion areas like over here, we're able to categorize and locate, and then dents and cracks as well, enriching the data asset model. We want to go further than that. We incorporate other sorts of components like piping and pumps that you see here, both in the inlet and outlet. This is extremely important and valuable because we keep on adding data layers. And the next one is a dog. Come here, boy. Good dog. Hey. Everyone say hi, please. Yeah, there we go. Nice. So let me pet him real quick. He likes to be pet. Yeah, good boy. So this dog will walk around to dangerous environments, gathering information about what's going on the infrastructure. Now, what's important also to understand is that because of an API platform for robots, we've built an extensible way for a company like Anybotics, one of our partners, to be able to gather information and data sets. And this robot is extremely exciting because it's built to be explosion proof, meaning it can go inside of oil and gas facilities, nuclear facilities, and beyond. It's gathering information like you see above, thermal imaging to understand what's going on with the asset. All this data is really important when we do optimizations later. And we want to begin to continue to gather more information about the asset. So we've sent in submersible robots. These submersible robots are looking at the deformation because of the weight of the liquid, as well as the health of the asset's floor to prevent things like that oil tanker leaking into rivers. And once we've gotten to this, and the customer is really excited because we do this while they're online, we then send in our robots and we rise, collecting information and data while the customer's tanks are still in operation. Now, these robots that you see right here are armed with ultrasonic sensors, cameras, and IMU on board to ensure that we can do this autonomously, gathering terabytes of data in 12 hours for this tank, a process that used to take about a month to do while the asset was shut down, costing millions of dollars. And we can do this in a way as well that ensures that we can localize data points to begin to run optimizations. And in this case, because these assets are supposed to be reaching their useful life or reached it, we can extend the useful life of the infrastructure. And so for this example, we can tell them what to fix in 5 and 10 years to extend the useful life so that this asset continues to be able to do its function, opposed to having to replace it for $8 million, which was what the plant thought they would have to do. So once we do that predictive model, we work with maintenance companies to ensure that they actually take action on that. And we update the model to ensure that a source of truth remains. Next, the customer actually wants us to begin to do other optimizations. So we use fixed sensors like this that'll stream information about not just the health, but also the operating condition of the facility. You see, when you're running let's say a big manufacturing facility, your goal is to figure out how to make more product without having stuff blow up because of a new operating condition. Now, that's never before been possible because the data you've been able to work with has been from Joe on a rope. And so you don't know if you change your throughput or make more product, if that'll destroy the assets. We're able to run optimizations. Now, I'm going to show you that here. So this customer was able to, because we're streaming in information and data from the pumps and from the asset itself, we were able to figure out how to increase the throughput or make more product by about 5% more, while only having to incur over 90 days an accelerated damage of the asset of about 2 months, equivalent to 2 months. And so we've proved that we could do that by actually lowering the fill heights in the tank and increasing the acid concentration level. You can see the optimization being run right behind me. Now, this was significant because of the ability to not just extend the useful life, but actually produce more while not having the potential risk of a catastrophic failure, something never before possible for these companies.
All right, I'm going to stop it there. David Braun, again, as an engineer's, from an engineer's perspective, what are your thoughts? What are your thoughts on a company like that? Again, not recommending it, but just showing the amount of productivity that can be had through innovation.
Oh my gosh, it's like incredible. I mean, I know a company we were doing some coaching with. One of the things that he does is he goes and inspects fuel tanks, gives reports and all that, right? And so this can kind of, replace it in a really, really good way, not just for, say, some of the initial inspection, but for the monitoring it, being able to maximize the asset that's being used, increase throughput. We watch it. I mean, it's just great. I think it's awesome.
And when you look at something like what's called the TAM, total addressable market, for something like this, again, I'm telling you guys this because to understand investing is to understand business. The total addressable market for something like this, it could arguably be trillions of dollars of infrastructure, right? And then that would be the cost of replacing these things bit by bit. But then you talk about the productivity of the individual companies, how much more throughput they can get for their product. Colin, what's your take, bud?
Yeah, well, one of the other big benefits that at least I see, especially when we're talking about some of these pockets of infrastructure, ports, bridges, etc., is also the reduction of human life lost or the disabling of them, right? So we can replace otherwise extremely dangerous jobs with very cheap labor via these robotics, and they can do things that we're currently not capable of. Right. So, and the reason I bring this up is you often get this narrative, especially with this big AI wave right now, that like, oh, all these humans are going to be displaced, et cetera. Well, part of those humans are doing very, very dangerous jobs. Right. And in my opinion, those are the jobs that the robots should replace first. Right? Not only the ones that cause the massive disasters like all of those tons of oil spilled into the ocean or whatever it is, bridge collapsing, et cetera. But we also get the efficiency of these things, monitoring certain projects that we currently don't have the capability to do just on our own human efforts.
Well, to that safety point, if I remember correctly, because I watched that speech a while ago, one of the human jobs to do stuff like this was to actually scale down a missile tanker.
Yeah,
this is
there
the
you
guy.
go.
And he'd have to knock on the missile to see where the weak part of the metal was. I mean, I don't know any of you, like Jessica, I don't know what you would think about your husband going down and he's like a missile knocker, right? Like it probably doesn't give you the warm and fuzzies, right? Regarding, your children's futures, et cetera. So Joel, what's your comment, bud?
Yeah, I think we talked about this briefly last time when the California fires, because they had actually robots or were replacing human beings and saving lives. I'm absolutely positive they were saving lives and doing some of the cleanup and some of the work that's being done out there. So that's where capitalism, I think, gets the bad rap that, oh, it's always about the money and the dollars and it's an evil concept. It is not. Capitalism has saved more people out of poverty and made the world safer over the course of history than any other system on the planet. Is it perfect? No, it's not. It's got its warts and it's got its, it's got its bad actors, but I can promise you that we do not want a world without capitalism that doesn't invent things like this, because it's making all our lives better and safer. And if we weave that into how we invest and save money, then all the better.
Absolutely. And final component on this, final words of wisdom for me, then let's pass around, is sometimes because you just see your statements and people talk about investing at too high of a level where it becomes abstract and you don't actually understand what's going on at the ground level, the value creation in exchange for dollars and it being a fair transaction, and you're investing your capital into that fair value transaction. We want to zoom in on those and say, okay, that's what's actually happening. Not I'm gambling. I'm just putting my money on red and hoping that it turns out on red. That's crazy. We would never recommend that. Those are my final words. Colin, let me throw you the mic, buddy. Final words of wisdom, pal.
No, this is a great chat. Hey, this is growing, right? We are starting to see more people, new people show up. I'd encourage you to keep coming, and if you can't come, we always record these and send them out after. So it's a big way that we get in front of people with topical conversations. So it's a really, really important part of the investing process and the relationship that we have. So again, if you can't make it live, I would still highly encourage you to listen to it on the recording on the back end, and feel free to share it with a friend, a family member, a coworker, etc. Maybe it's helpful for somebody that you know and love and like out there as well.
Awesome. Joel, final words, buddy.
Just to be, I don't know that we went over this, but this is supposed to be interactive, and it was pretty interactive today, but there's a lot of times when we just kind of talk and there's not many questions. If you have questions in between, or we don't get to a question that you want answered, send them in by email and we'll answer them on the next one, or we'll give you a direct answer so that we're always getting the information out to you that you're looking to receive.
All right. Awesome. Love you all. Thank you very much. David, thanks for playing along, buddy. If you guys have any
Thanks,
questions,
David. We appreciate you guys. Thank you very much.
Yeah, anytime. I'll send you my bill afterwards.
All right, buddy. Yeah. Send us the invoice. Send it to Colin, please. Yeah. Thank you, guys.
Sure.
All
Thanks,
right. See
guys.
ya.
Bye.